What people may or may not know about tax depreciation is that our report will start from when they get the property, and you can amend to previous financial years worth of deductions. Let's say we're claiming $5,000 a year for 10 years. We've got $50,000 worth of deductions. Well, what's the point in claiming $50,000 worth of deductions when you have to give all of that back?
What are some of the triggers that might, make sense for you to go and investigate whether you should get a depreciation schedule and whether that could actually save you some money?
In the 23-24 financial year, the average amount property investors were spending on an investment property was $650K. And if you removed outliers, because we have sometimes people spending $10 million on an investment property in our data for whatever reasons, it was actually only $550K. So most investors aren't going at that 800 plus price point.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to another episode of Perth Property Insider. Today we've got Mike Mortlock from MCG Conveyancing on the show. I'm a big fan of his Geared for Growth, if I've got it right, podcast, and tune into many episodes. And today we've got him on our show to share his insights on the biggest difference that tax depreciation can make to the average investor, how there's so many unclaimed dollars just sitting out there. And Mike's an investor himself and got a lot of insights to share. So excited to have you on the show, Mike.
Oh, well, I'm excited to be here. So thank you for the warm introduction.
Well, we haven't actually. I said when we were chatting pre-show that I've never actually had anyone on to talk about depreciation because it can be a pretty dry and boring subject. But somehow,
well, you're worried about ratings, right?
Yeah, exactly. So, we're 5 years into the show. We haven't come around to it, but
you've held out strong for 5 years.
Yep. As I've listened to your stuff, I really think it's an often overlooked area. And tell us a bit about just how overlooked it is for many property investors.
Yeah, well, we don't necessarily have the data on how well it's overlooked. The ATO tax stats we get, and we can sort of see what the capital works deductions are for people. And there've been some commentators that say, okay, well, our average deductions are X and people are claiming this, so there's a gap there. But what they're not necessarily looking at is they're looking at, well, what the average first-year deductions are. But some of these people are 5 years, 10 years, 30 years into their investment property journey. So what they're claiming is not necessarily year one. It might be year 30 and that sort of thing. But what we do know is we've conducted research where we looked at 1,000 residential transactions that came through our business, right? So we did 1,000 residential tax depreciation schedules. And what we were looking at was the time between when they acquired the property, which would either be their settlement date or when they built the property, if they built it, and then how long it actually took to get in touch with us. Now, what people may or may not know about tax depreciation is that our report will start from when they get the property, and you can amend to previous financial years worth of deductions. So if you bought a property 2 years ago, you can get a report, go to your accountant and say, I've never claimed this. And your accountant can amend those previous returns to access those deductions. So what we were looking at in that 1,000 sample was how many people waited so long that even with that 2 years of back claim, they would still miss out on depreciation deductions. Now, the magic figure that we got to was 6.7% of those 1,000 depreciation schedules that we did. And the average amount that the investor was missing out on was $20,537. So what I did at that point in time, because we were working with journalists who were helping us with PR stuff, they love clickbait. So I thought, well, how do we make this sound as crazy as possible? So at the time, we extrapolated that across the investor population. So if we looked at the number of property investors, we gave 6.7% of them $20,537 worth of missed deductions. It worked out to $2.88 billion worth of unclaimed deductions. So that is at least one methodology or one way to say what is actually left being on the table. And if you look at often we have these conversations around negative gearing, the productivity commission's now talking about it. We had 2 elections where Labor were talking about it. It just hangs around like a bad smell. But on a long-term average, the amount that the government loses to negative gearing from property investors is around about $3 million, right? But we've got $2.88 billion worth, $3.8 million. But yeah, we've got that $2.8 billion worth of deductions that are being unclaimed. So that hopefully puts it into a bit of perspective.
Well, the government might get a shock if all these investors listen to our show and suddenly come up wanting the tax deduction all in the same year. But thankfully, my audience reach isn't that wide.
Oh, look, the funny thing is it's an entitlement, and it's not a tax loophole. It's not a new thing. Negative gearing has been around somewhere around 1936. It applies to other asset classes, whether it be a business, whether it be shares. So it's actually an entitlement, and I actually think it's a really good deal for the government. So if you're having to pay, let's say, $3-4 billion for negative gearing allowances, well, the government is really out of the public housing business. They own around about 330,000 homes, right? So to replace what property investors do, let's say the government had to go and buy 3 million rental properties based on a normal sort of median price. The last time I crunched those numbers, it was about $2.4 trillion. So I actually think the government would be very mad to take these entitlements away, because investors are actually performing an important service. They are providing housing, and you can only claim those negatively geared allowances if you're losing money. And the majority of sophisticated or multi-property portfolio owners aren't negatively geared anyway. So when Labor was talking about taking that off the table, the people that I was sort of speaking to that were sophisticated investors were saying, well, I don't care at all. It's the mum and dad investors, which is probably a slightly out of date term, but the people that are only buying their first property, or they have 1 or 2, which is 90% of investors have 1 or 2 properties, they're the ones that would actually be targeted by that sort of legislation. And what do we know about those people? Well, they're trying to make prudent financial decisions to better their financial future and quite possibly take themselves out of qualification for the old age pension, which we forget has a cost as well. But I'll park my soapbox to the side and we'll move on to the next one.
Don't get me started either. But let's go to depreciation for a minute, because as you mentioned, we've got these entitlements, and it's not just free money necessarily. Like, your actual asset is, depreciating and becoming worth less over time, and it does have a replacement cost, and you need to maintain that as an investor and keep your asset value sort of there. So the way that I kind of look at depreciation is, if I can claim back that against my tax and save some money along the way, I can put that into maintaining my asset and, offsetting that wear and tear and stuff ongoingly. But you still have to deal with that later if you ever sell the asset. So tell us a bit more about what is depreciation and how that kind of fits together for the investor, both, during the life cycle of ownership and then at the end.
Yeah, so when it comes to investing in property, of course, you can do it in a number of different structures. You can buy it in your personal name and trust, and there's different rules for how it works, depending on how you do it. So let's just focus on personal name to start with. So when you purchase an investment property, you've got ongoing costs that you're able to claim as deductions. The biggest one is normally the interest component on your loan. I would argue that the second biggest is normally tax depreciation. And then you have things like property management fees, you have repairs and maintenance and rates and all those sorts of things. So what does a tax depreciation schedule actually do? A good way to think about what we do is think about a property valuer. We go to the property, we take some photos and measurements and notes, and then we provide you with a report, a PDF even. I've joked before, I'm in the PDF business, right? But what does that PDF do? Well, it tells you what you can actually claim based on the decline in value of the assets that attract the deductions in a property. So if we think about a house, there's different qualification dates, and I don't want to get sort of too crazy about it, but let's say a house that was built in 2000. Let's say the construction cost for that property was $250,000, and we might say that $200,000 of that is structural and 50,000 of that is plant and equipment items. So the rules for plant and equipment items did change in 2017, so you can't claim deductions on anything established. But plant and equipment are things like carpets, blinds, and kitchen appliances. So the leftover, the structural stuff, is things like bricks and concrete and timber and cabinetry and shower screens and all those sorts of things. So if we go out and we assess that report will have $200,000 worth of Division 43 or structural deductions, then it's a flat 2.5% depreciation rate each year from the date of construction for 40 years. So in this example, I said it was built in 2000. It means you'll get $5,000 worth of deductions each year from the time you purchased it until 2040. So with that $5,000, what is that? Is that in your wallet? Do you get to put it straight in your pocket? No, it just comes off your taxable income. So if you're earning $100,000 as a property investor, now in the eyes of the tax office, you're only earning $95,000. So you're getting taxed on 95 rather than 100. What is the value of that? Well, I suppose after tax, from a cash flow perspective, it's just easier to hold on to that property. Typically, at least 2/3 of properties, depending on where we are in the cycle with interest rates, but 2/3 of properties will be negatively geared. So these deductions are just able to minimize your income. And then, of course, that's what you're paying tax on. So you also asked the question, well, what happens at the end? And that's often a question that I feel like gets heckled at me. Like if I'm doing a presentation, there'll be someone surly at the back, someone a bit disenfranchised, a bit glass half empty, and there's a hole in the glass and we've run out of glass making manufacturing plants. They'll say, well, what's the point? Let's say we're claiming $5,000 a year for 10 years. We've got $50,000 worth of deductions. Well, what's the point in claiming $50,000 worth of deductions when you have to give all of that back? The reality is that what happens with depreciation, let's say we bought this property for $1 million and we sold it after 10 years for $2 million. Well, we've got $1 million of capital gain. What happens with the deductions that we claim is it reduces your cost base at the start. So instead of us buying it for $1 million, we've actually technically bought it for $950,000. So we've now got $1,050,000 gain. So then the way to break it down is like, okay, well, you're not necessarily then paying tax on $1,050,000 because you have the capital gains tax exemption, at least at the time of recording. I don't expect that to disappear though. So we cut that in half. So instead of that $1 million capital gain, it would be 500. So in this case, when we are cutting it in half with $1,050,000, it would be 525. But then not only do we get it to be cut in half based on the capital gains tax discount, it's then only at your marginal rate of tax. So if you're someone that, is on a high income, it's almost in half again. So we might be claiming $50,000, but we might only have an exposure to, say, $10,000 or $12,000 that we need to repay. Now, to me, that's a compelling enough argument, but I feel like the nail in the coffin of that surly person who's still not convinced is, let's consider the time value of money. And we've both lived through relatively high inflation in the last little while. I feel like all the listeners have probably felt it in some way, going to Coles or Woolies or a million different things that we need to consume. The hardest time to really hold on to an investment property is day one. So getting that cash flow at the beginning is more meaningful than 30 years down the track when you sell it and having to worry about that. And also that dollar today is worth so much more than it is in 10, 20, 30 years whenever you sell the property. So it is something that you have to consider, but it's not a good enough reason to throw tax depreciation away as a bad idea, which sometimes it is thrown out that way.
Well, the way I look at it as well is at the beginning is often when your cash flows the hardest and you need the most sort of support from negative gearing and depreciation. It makes it easier that first 5 years. You get through that and then the property is likely to be neutral, and it really just helps you with that initial period when you need it most, I think. So
yeah, because you may pay down the principal, so your repayments are lower, but at the very least, you have a reasonable expectation that your rent will rise at some point in time. So you're absolutely correct. And I do always say at the beginning, that is the hardest time to hold that investment property from a cash flow point of view. It really shouldn't get any worse than that. Of course, if interest rates go up by 2% because some crazy things happening with the economy, there's some asterisks to that. But normally you want the deductions as soon as you can get them.
Awesome. Well, I know you're big on your research and putting together lots of data. Being a fellow, I don't know, we call ourselves nerds, or it's kind of. I love diving deep into data and making sense of it for people. So, tell us about some of your insights on what's the most active market for investors at the moment.
Yeah, well, the if we look at say 2024, the statistical area 3 that was the top of the pile was actually Townsville, which is interesting for me and quite a good news story, I would say, because Townsville was really one of the best performing markets in 23, 24. Outside of Townsville, the states that have been most popular, it has been a fight going back and forth between your great state of Western Australia and Queensland. And I think Queensland has definitely benefited from a number of different hotspots. I mean, Brisbane has been performing terribly well for a long time. You've also got Toowoomba, you've got Townsville, as I've mentioned, and there's quite a few markets in and along the coast that have done really well. So depending on the sample time frame, WA, say Perth, and it's typically in and around Perth. We don't necessarily see other locations sort of booming. You know, you do sort of see places like Busselton come and go. And see, I throw Mandurah in the sort of Perth bucket, which is maybe not fair for a local. But yeah, so Townsville was number one, but really Queensland and WA have been the ones that have outperformed. And you contrast that to a place like Victoria. That's obviously really, really changing now. But when the land tax came in, it was running at around about 12% of all investors that worked with us were buying in Victoria. That dropped very quickly to about 4% on the land tax. And now I expect that Victoria is probably going to be in third position and may start challenging Western Australia or Queensland because it is just all about the cycles as well.
Yeah. Well, that's good. I mean, I keep people updated on these things, but it's good to have it told from a different angle and from a different data sources. So tell us a bit more, like how far do people tend to live from where they invest? Because I know when you're starting out, you're in your little comfort zone. You might be traveling to the shops on the weekend. Someone's told you about buying an investment property at their barbecue. Seems like a good idea. You go past the open for inspection sign, and before you know it, you own two properties in the same suburb, and and it's because it's where things felt most comfortable for you and where you know best. But there has also been this emerging digital herd, which we'll go into maybe a little bit as well. But they're investing more with data and evidence based, or some of them are. Others are just following where everyone else is going and buying there too. So it'd be interesting to see, the stats on, where are the majority of people buying, and how is this being made up at the moment? Are they buying local in their same suburbs still? Are more embracing this, buying interstate and having a bit of diversity in their portfolio? Like, what are you seeing from your data?
Yeah, look, well, this is a thought experiment that we had in 2019. Now, we didn't know that the global pandemic was on its way to us. So what was really interesting for us was to look at it pre-pandemic, mid-pandemic, and post-pandemic. And like you say, there's this kind of idea that investors aren't terribly sophisticated and they buy around the corner from where they live. They buy where they're comfortable. And when you speak to people like that, you can ask the question, okay, well, why, what made you buy here? And you're like, oh, because I know the area. And then when you sort of ask them the next level question is like, well, what do they know? Well, they know the good schools. They know where the best restaurants are. They know you don't buy in that street because it's, full of violent people that graffiti things. But they don't necessarily know how diversified the employment base is. They don't necessarily know the demographics of the people that live there. They don't know the historical performance. So it is kind of weird when people do that. And I've always sort of said it's not a good idea to consider that, well, the best place to invest in the whole country just happens to be the suburb that I live in. Now, for some people, that might be true. If you lived in Townsville in 2004 and you bought around the corner, well, you just so happen to be in the best performing thing. But what are the chances, right? And you're putting too many eggs in the basket. But anyway, let's get to the data, because people will be thinking, wrap it up, buddy. I want to know what the numbers are. So we actually expected that, it might be somewhat true that people will buy typically around the corner from where they live or quite close. But in 2019, the number, or the distance in kilometres, was actually 293 kilometres, way bigger than I actually expected it. And if you look at the breakdown, I mean, a journalist could tell a number of different stories. 6.9% of investors were buying in the same suburb. There was 60% of people bought within 50 Ks. A third of people bought within 10 Ks. 10% of people bought within 2 kilometres. So there is, within that data, the 293 is a big number. We had 29.5% of people buy more than 200 kilometres. So let's say a third of people probably bought so far that they might not inspect it themselves. You don't necessarily know how far people are willing to go or what have you. But 293 was the first number that we came out with. So that was 2019. Then in 2020-21, we recrunched the numbers and it went up to 559 kilometres, which was a really big surprise. Now, why did it grow so much? I think it probably coincided with the expansion of buyer's agents or borderless buyer's agents. I think we also benefit from much more available data on markets around the country. I think we heard a lot more about people, hot spotting and looking at these locations. But the story didn't really end there. Once we got to 2022-23, it was 800 kilometres. And in 2024, it was actually 1,500 kilometres. And we've seen it as high as 2,000 kilometres. Now, I sort of said at the 1,500 kilometre mark, it probably won't go any higher. I expect it to come down. I was wrong. That's the beauty of data. You have a hypothesis, but it tells you the story. But really what the story was for me in that data point was the rise of Perth. Because at particular points in time, we had 40% of all of the investors that we're working with buying in Perth. It was an absolute gold rush. You would have seen it on the ground. A lot of these East Coast buyers agents and East Coast property investors. So the majority of property investors in Australia are going to be based on the East Coast. So just by virtue of the fact that it's a bloody long way to Perth, I don't know, some 3,500 kilometres.
We're very isolated. Stretch the number.
Yeah, exactly. So that's why the number went so high. Now, when we've got Perth, I mean, Perth is still posting good numbers. It's quite surprising to see the recent numbers. So it's still technically the peak of the market, but the pace of growth has definitely slowed quite markedly. But we're also seeing a lot of investors going into places like Darwin. Again, that will influence the numbers because Brisbane, Sydney, and Melbourne probably house the vast majority of property investors. Darwin, I mean, the argument is probably to say that if you were going to buy there and you're happy with the risks in a market like that, which we can talk about, yeah, it's that has probably passed. The best time to buy is probably passed. So now we'll probably see a little bit more in the sort of Victorian markets and Queensland continuing to go. So expect that number to come down. But I loved doing that because I hadn't seen that published anywhere before. I don't know if anyone actually has that data. I don't think ABS or CoreLogic has that data, but we get the property address of the person that we're doing the depreciation schedule for their investment, of course, and we get their postal address as well. So that enables us to crunch that figure. So very interesting to see it go from 293 all the way up towards 2,000 because of Perth.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join, and make sure you're receiving my email updates.
Well, I think one of the underlying things that is also driving this, which I interpret from the data, and I don't know, it'd be good to get your take on this, but we've seen the majority of people buying into Perth where, because prices everywhere else have increased to such an extent, investors really to buy a reasonable quality of property now, they have to look further afield. We continually see a lot of the Sydney-based investors where, rather than even buying a home, they can't buy the home that they'd like to buy. So they rent where they'd like to, rent best that, and then buy over in Perth where they can, for what they'd spend on a tiny shitbox in a multi-high density complex that faces a wall, they can still buy a 4x2 that's got a full backyard, and it's going to be very desirable to both buyers and tenants. So I think that affordability is pushing people to have to go outside of the comfort zones of their states as well.
Yeah. Yeah, look, I would completely agree. I would categorize 2023-24 as the rise of affordable markets. And if we think about Perth, for example, pre the run on Perth, for want of a better term, it was the second cheapest capital city market in Australia after Darwin, right? And there's a lot of people that would say, look, if I'm a little bit hesitant about Perth because of its exposure to resources, then, well, Darwin is Perth on steroids for that sort of lack of employment diversification. But also, I think what has really helped Perth as well is, yes, it's a relatively cheap market, but in terms of affordability, the metrics are really, really positive. In fact, the metrics still have legs. So what I'm talking about there is your average household income to asset price. Despite the boom in Perth, it still actually outperforms other states. So I think, yeah, absolutely, the affordable markets were where it's at. And to some respect, I think that has still fueled Darwin. If we get a couple more interest rate cuts, it'll be less important. The investor budgets will go a little bit further. But look at the markets that people are going to now. They're going to Darwin. They're going to Melbourne. I mean, Melbourne's median house price as at August was 803,000 compared to Perth at 841. So it's overtaken Melbourne, So people are looking at that. The land tax impost has really kind of been priced in because the market's really suffered. The economy's not doing very well in Victoria, but people are just kind of saying, look, Melbourne's going to be bigger than Sydney. That's obviously been modelled out. It will overtake. And it's a blue chip part of Australia. A lot of people live in Melbourne. It's a very desirable city to be in. I mean, I don't typically like the weather this time of year, but it's still a beautiful place.
Well, there is certainly some headwinds, and the Residential Tenancies Act's not exactly appealing to investors either. But, we've been, the two places we're buying for our clients with our buyer's agency is Perth and Melbourne. And those that have got a fair bit of concentration to Perth, we're diversifying into Melbourne, and it's, a bit of longer sort of medium to longer term time horizon. Whereas I think Perth's, more of a bet for the next 1 to 2 years. But the places we're buying in Melbourne are already starting to see strong growth, and affordability is driving those areas too. So that said, I think there's opportunity there, but you have to also be willing to accept. Still the yields are quite low. I get shocked when I'm looking at for an $800,000 house, you're sometimes at 2.5% to 3%. Whereas if you're buying that in Perth here, you're at 4 to 4.5%, which makes it a lot easier to hold. But I think the market there, if investors keep leaving in the droves that they are in Victoria, and things continue to be unappealing for all the reasons that you and I have just mentioned, we've seen that cycles have to reverse. So the government will probably get kicked out or have to face changes that they need to make. They have to face the fact that they need investors. Rents will start spiraling up and going out of control. And then the yields will come back. Investors will then start, the later investors, not the early adopters, will start to join the party. And then that will then start increasing demand. And home buyers will want to get out because rents are going up. And the cycle will come around again.
Yeah, exactly. It's really been interesting to watch Melbourne from a data point of view. So if if you're only looking at core logic, and let's say someone listening is someone that's bought a property in Melbourne, whether they're a client of yours or not, they could be sort of forgiven for thinking, well, this is like Melbourne's not doing very well. I mean, August it posted 0.3%. But the reality is, I mean, even though it has quite a low median at 803, the vast majority of investor transactions, I would hazard a guess to say, are significantly below that. For example, in the 23-24 financial year, the average amount property investors were spending on an investment property was 650K. And if you removed outliers, like because we have sometimes people spending $10 million on an investment property in our data for whatever reasons, it was actually only 550K. So most investors aren't going at that 800 plus price point. So that's kind of the way that median can sort of pervert things. It depends on the price segmentation. So to give you a bit of an example, I have a friend, a buyer's agent in Melbourne, and a couple of years ago, I saw the median really coming down. And I said, what's going on with Melbourne? It's tanking. But what she actually said, well, the first home buyer grant had been extended and it was capped at a certain point. So there was this flurry of activity at this low price point. So then every time a transaction is recorded, it's below the median and it's dragging it down. So just, I suppose I throw that out there as a cautionary tale to say, don't get obsessed with these medians and based on the capital cities. You cannot buy the Melbourne median. You cannot buy the Perth market. You buy a house, you buy a unit in a particular location. And I'm sure if you break down the data, there will be suburbs in Melbourne that have done double digits and way more in the last 12 months.
Yep. There's always markets within markets, and that's why, you can't just throw darts at a board and hope to do well.
No. Some years it feels like you can do that.
Well, you could for Perth previously, but I think moving forward, we now need to be a lot more selective and by, where the areas are not overvalued and they're still, getting demand and still trending the right way. And that's where the opportunity still lies in Perth, I think.
Yeah, I agree.
So you obviously have a lot to do with new construction, and a lot of people sort of don't appreciate the role of what quantity surveyors have in that space. Anyone to build a new building, whether that be a house, larger development, they need to know what things are going to cost. And I know that that's where you have a lot to do with as well. So tell us some of your insights on the construction costs and what this is going to mean for investors in the housing market, because what we've seen in Perth is I get excited every, a few times a month when a client reaches out to me and says, Jared, I'm thinking of doing a development. A lot of the time we look at it and even on the back of an envelope, the numbers still don't stack up. And it's sort of very rare that it does. And you really need to be working off of today's values for everything, your end sale prices, your current construction costs, and then factoring in, holding costs and really working off of, what's going to be a profit and be worth that capital expense and the risk that you take. So we still haven't yet seen, with hopefully building costs will start to stabilise, and as established prices continue to move up, that profit margin will start to be worthwhile. But what are you sort of seeing across the board with construction costs and how this might play into that?
Yeah. Well, I think construction costs really moderated going back probably 2 years ago. And so the pace of construction cost growth is fairly well aligned with the long-term average. What we're actually feeling is two things. The pace of construction growth went through the roof during COVID. Like we're talking around about 30% in that 2 year period, which is just absolutely crazy. What we're also seeing is a shortage of labor. So labor is the big constraint. We probably need another 90,000 tradies, according to the HIA and the master builders. And of course, we did see that in the last budget speech, that there were incentives for hiring apprenticeships and cash bonuses for apprenticeships. But let's even sort of think about the labour force that we have at the moment. Another thing that people don't necessarily consider is that there has been a huge pipeline of government-funded infrastructure. I'm not as super familiar with Perth, but in Sydney, we've got the second airport. In Brisbane, you've got the Sunshine Coast Rail Link, everything going on with the airport expansion, the Queen's Wharf, the Olympics. In Sydney, you had the Metro Tunnel, and there's always projects going in there outside of the Western Sydney Airport. Victoria, the big rail loop, the underground stations, and that sort of stuff. So what actually that does is it attracts the tradies away that might be building the homes to those projects because, in all honesty, that's where the money is. Outside of that, we also saw tradies get pulled away from that for insurance work. So I had a conversation with one of the top three national home builders by volume a couple of years ago, saying that they can't get roofers. And I thought, what do you mean? Like, working with you is a golden ticket, I would assume. There's constant pipeline of work. Tradies would want to pitch their flag with you because they're never going to run out of stuff to do. But they said, look, when they're getting 2 or 3 times the hourly rate doing insurance rectification work, we just can't hold on to them. Because I suppose if you think about an insurance company, if you're displaced from your home because you've lost the roof, well, there's a cost to the insurance company to rehouse you somewhere else. So they are actually in a hurry and will pay a premium because it makes sense to them. So with that labour shortage, we've also got it being pulled in a number of different directions. So the pace of construction costs isn't a problem, but it still is. I mean, it hasn't gone down from that rapid upswing from COVID.
Kind of stayed there, didn't it?
Yeah, we wouldn't necessarily be having this conversation. We might still be talking about labour shortage, but the huge increases that we saw in things like materials like timber, steel, concrete to somewhat of a lesser extent has kind of washed through. More than 60% of construction materials come from overseas as well. And of course, we saw the cost to get a shipping container shipped around the globe just go through the roof with some of those Freightos Baltic indexes. So we are just at that point where sometimes the metrics kind of work. It's like the journalists will sometimes talk about, here are the places where it's cheaper to buy than rent, right? And that story comes up every now and then. Here are the places where it's cheaper to get a block of land and build a property. We're not hearing those stories. There is a premium for those new properties. And until the prices continue to go up and construction costs sort of stay broadly trending along at their sort of CPI plus maybe 0.5% level, we need that to happen for it to go on. And let's go back to the federal government and their press release about the 1.2 million homes in 5 years. We are roughly 30% behind that target. When that came out, I basically said that it was over before it began. It was a target that couldn't be reached. It's basically trying to look at the best we've ever done in construction and do it 5 times in a row in a period where construction costs are high, interest rates were relatively high at the time, and we had a labour shortage. So it was just fanciful to think that we could do that. So we do have a problem with construction. It's not necessarily the construction costs growing up. It's just it got to a high point and it still remains there. And the implications for that, well, if you are a property investor, it's good news for you because the supply, which is like a competition for investment property, it's not coming on at the pace we need it to. I wanted to maybe try and avoid too much of a chat about immigration, given all the protests we've had in the last little while, but that factors into it as well. Immigration has actually been cut quite rapidly as far back as I think it was 2 December quarters ago, or 2 years ago, in the December quarter, the government really intervened on immigration. But still, that 1.2 million homes, if you average that out on year to year, right now we kind of just need that for the immigration uptake, not just the backlog, right? So that definitely has factored into it as well.
Makes sense. So getting back to being the typical investor, what are some of the triggers that might, make sense for you to go and investigate whether you should get a depreciation schedule and whether that could actually save you some money?
Yeah, look, I always just say no matter what, reach out to a quantity surveyor and get a free assessment of whether it's worthwhile or not. I mean, obviously we do that. I don't think we're unique in that. I don't think any quantity surveyor is going to charge you to say, look, is it worth doing? Because that's the first sort of step in our due diligence. Is it worth paying our fee on your property. And the way that we classify that is that we want to find at least double our fee worth of deductions in the first full financial year of claim. The report lasts for 40 years, but we want it to be paying for itself within the first 12 months and make everything a bonus. So I would say to people, if you're not sure, all you really need to do is send the property address. Normally there's online photos. We can look at it. If, they're a little bit out of date, we can say, well, have you done anything? Have you made any improvements as the previous owner? But I'll give you 3 points that are a fairly good guarantee that it's worthwhile so that you can have that education yourself. The first is if you buy a brand new property, and we kind of touched on that before, the plant and equipment deductions for carpets and blinds and ovens and cooktops and hot water systems, they only exist if you either put a brand new asset in. So if you could have a 10-year-old house and put brand new carpet in, you can claim the carpet. But if you buy a 10-year-old house, you can't claim the deductions. But if you buy a brand new property, all the deductions are there. You've got the structural deductions undeducted. What I mean by that is that 100% of the value is there, whereas if you buy it 10 years down the track from construction, you've only got 30 of the 40 years available to you. So a brand new property, we fairly well know that it's always going to be worthwhile getting a report done. The second one is if it's built after the 16th of September 1987. Now, I would encourage you to even forget the numbers that I said before 1987 because it's too hard to remember, and I don't want to push your PIN number out the back end and all the important stuff like your wedding anniversary or whatever you need to remember. But if it's built after 1987, that's the cutoff date for depreciation claims on the original building structure. So the things that aren't plant and equipment, that are the structure, like I mentioned before, bricks, timber, whatever the roof is made of, retaining walls, fences, driveways, all those things. If it's built after 1987, you can claim deductions on that. So let's say the property has $100,000 worth of those components. It was built in 1990. You're getting 2.5% or $2,500 worth of deductions each financial year. So it's brand new. It's built post 87. The other one, and this is where I think people get in trouble, and I've even heard accountants give advice to say, okay, it was built in 1970. It's not worthwhile for depreciation deductions. I've done reports on properties built in the 1910s that were worthwhile for depreciation deductions. The original building structure won't qualify, but we need to consider the history of that dwelling. Has it been renovated? Has it been extended? Has it had a new kitchen and a bathroom? And 1987, I mentioned before, was the cutoff. Think about a property built pre-1987. That's a very tired and ugly looking property these days, right? It's not going to get you the best quality tenant. It's not going to get you the best rent. It's not going to be great for a valuer to come and revalue for market value for to pull equity and buy another one. Most properties will have some improvements. So you don't have to have done the work yourself. The previous owner could have done that. And as quantity surveyors, we're qualified to estimate the value of those works. And I like to say about $40,000 or $50,000 worth of improvements is about the break-even point. So anything more than that, it's worthwhile to you. Now, it begs the question, well, how do I know how much the previous owner spent on renovations? If they've done a kitchen and a bathroom, it's fairly safe to say you're probably over that mark. You used to be able to get a kitchen and bathroom reno done for 20 or 30 grand. These days, it's probably the call-out fee for the tradie to come and quote for it because they're having a hell of a good time because there's a shortage of tradies. But yeah, if it has been extensively renovated or improved, you don't have to have paid that money for those works. It's baked into the purchase price of the property. You become the new owner of those assets, and we're qualified to estimate it. So they're the 3 ones. It's brand new, it's built post 87, or if it doesn't match those 2, it's been improved or renovated.
Makes sense. And tell us a bit about what people don't know about claiming depreciation on older properties, because I know you've sprinkled a bit of it in there. Is there anything else that stands out that might make it worthwhile to have a depreciation schedule?
Yeah, look, what I would sort of say to people is that I've even heard quantity surveyors say this before, that new property is always better for depreciation deductions. And, we talked about us being data nerds before. And I would say, well, okay, generally speaking, new property is better, but it's not always better. So, for example, let's say a project home costs $400,000 to build. You might get $15,000 or $20,000 worth of deductions a year. That's pretty good, right? But think of that property I was mentioning before, built in 1910. Let's say, what's the most premium place in WA? It starts with C. It always pops up.
Got us like
Cottesloe. Yeah. Now, Cottesloe is probably a bad example because it doesn't have like the inner city kind of built in 1910 terraces that are worth $8 million, I presume, that were, built a century ago. But if you picture something like that, it's not unreasonable for something like that to have had a $2 or $3 million renovation pre-purchase. So if it's had $2 million worth of Division 43 deductions on it, then it's going to 3 or 4x the deductions on a brand new property. So I just encourage people to sort of dispense that idea that newer is better. Broadly speaking, the newer the property is, the higher the deductions you can get. But older properties, depending on their history, can outperform them. And it sort of leads into something that maybe you might find of interest, is that I've had the question over the years, what's the best investment property to buy for depreciation deductions? And I used to answer that seriously and earnestly, but after getting it about 2,000 times, I kind of thought I need to have some fun with this so that it doesn't feel like Groundhog Day. And so I started explaining, okay, best for deductions. We're going to say a 1-bedroom apartment in a complex of 400, and it's going to have an outdoor and an indoor swimming pool and gym. It's going to have 12 levels of basements. It's going to have 8 lifts all the way from ground floor to the top. It's going to have a cinema. It's going to have little foyers on every level with amenities and kitchenettes and all that sort of stuff. And people look at me like I'm a little bit unhinged. I get that a lot. But in this example, they're kind of thinking, well, that sounds like a terrible investment property. And I say, yeah, just imagine the strata fees, like that'd keep you up nights. And I said, well, but that wasn't the question that you asked. The question was, what is the best for depreciation deductions? Now, why is that so good? Well, if it's in a complex of 100, you actually own, I said 400, you own 1/400th roughly of the lifts, of the swimming pools, of the basement. And we as quantity surveyors can go and estimate the value of that, and you get it. A 1-bedroom apartment is a relatively costly thing to build on a per square meter basis, right? Because it's got a higher percentage of wet areas like bathrooms, which are way more expensive to build than, say, the lounge room. And if it's a big house, it's got big open spaces. A 1-bedroom apartment has walls everywhere, right? Because it's a tiny little shoebox. So for those reasons, those properties are the best for depreciation deductions. So what I'm trying to get at there is that depreciation is a bonus. It's not a strategy. Don't go and invest in properties because they have the best depreciation deductions. Invest in the property that's going to satisfy your brief, whether it be, I want maximum capital growth, I want a balance of growth and yield. The depreciation is great. Absolutely claim it. Don't ignore it, but don't use that as your starting criteria. I think that's a recipe for disaster. And that's coming from someone who's dedicated their career and loves depreciation like I don't think it would be healthy for anyone else to do.
Well, thank you so much for adding that in, because I reckon it's a really good place to end our podcast on that. Depreciation's a great tool to have in your tool belt, but don't go, making every decision based on that. So we've touched on some great things today. I think if anyone wants to reach out and see whether their property is worth having a depreciation schedule done, I'll put your details in the show notes. It's MCG Quantity Surveyors, and I'd encourage people to reach out and just see what they could be missing out on in terms of what they could claim. So thanks so much for coming on the show, Mike.
Pleasure. Thanks for having me.
Cheers.
Cheers.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.